My greetings to everyone. In the ongoing series of Finance for Everyone, today we have a very important topic on insurance services. So in the first part of my lecture, I will be talking on life insurance policies followed by endowment policies. Now, what is insurance? Insurance is a financial product sold by the insurance companies to safeguard you and your property against the risk of loss, damage or theft such as flooding, burglary or an accident. So let me tell you something about insurance. Insurance is a system of protection against any kind of a financial loss. It works by transferring the risk of a potential loss from an individual or an entity to an insurance company. The individual or entity pays a premium to the insurance company which promises to pay out a sum of money in the event of a covered loss. So insurance is a way of mitigating the loss and providing the financial security. So if you have got the insurance policy, it is definitely going to give you a peace of mind because it is on to the insurance company that we are endorsing a kind of a risk. So it helps an individual to mitigate the loss and definitely provides the financial security. So from a financial perspective, let me give you a definitional aspect of an insurance. So insurance is a financial product that provides protection against the potential financial losses by transferring the risk from an individual or an entity to an insurance company in exchange for paying a premium. The insurance company agrees to compensate the insured party in the event of a covered loss, a damage or a liability. Now, the definition from the legal perspective. So, insurance from a legal angle is a contractual agreement between an insurer and an insured party. The insurer agrees to provide financial compensation for certain risks or losses that may occur in exchange for a regular payment, that is the premiums, from the insured party. So, this agreement is typically governed by the terms and conditions outlined in an insurance policy. Now, according to Mowbray and Bland, insurance is a social device for eliminating or reducing the cost to society of certain type of risk. There is important definition given by Ghosh and Agarwal. Insurance is a cooperative form of distributing a certain risk over a group of persons who are exposed to it. Insurance is widely covered, the most effective risk management tool available to an individual and the businesses looking to protect themselves from any kind of a financial loss that may arise from uncertainties or unforeseen circumstances. You never know. The only uncertain thing is what is going to happen in future. So definitely, if you take an insurance policy, it is a step towards mitigating the losses, not only of the individuals, but also catering to the businesses. While insurance can cover the cost of financial loss, it cannot compensate for emotional or psychological impact of these losses. Despite this big limitation, insurance remains an important means of mitigating the financial risk in situations where it is beyond our control. Now, coming on to the introduction part of it. So, insurance is a contractual agreement between the two parties, namely the insurer and the insured. That is commonly referred to as insurance policy or insurance coverage. So, in this particular arrangement, the insurer agrees to provide financial protection to the insured against the losses that may be incurred under the specified circumstances. Insurance companies offer this financial coverage or reimbursement to the policy holders in exchange from a payment which is called as a premium. The policy covers the losses incurred by the policy holders subject to specific terms and conditions outlined in the agreement. The premium paid by the policy holders determines the amount of coverage provided by the policy, also known as a policy limit. Now coming on to the characteristics of insurance. The insurance companies combine the risk of their diverse customers who pay the premium that are pooled into a accumulated fund. And when a few customers suffer from the financial losses, the claimed money is distributed from this fund. So this process requires each customer to contribute a small fees. Insurance coverage may vary depending on the type of insurance policy and can include the expenses such as medical bills, vehicle damage, property loss or damage, and more. The primary component of an insurance policy are the premium, policy limit, and deductible. When purchasing an insurance policy, it is very essential for each and every consumer who is buying the policy to carefully review and understand these elements. So to reiterate, there are three important parameters which have to be kept in mind before any customer buys the insurance policy. The first is the amount of premium he has to pay, what is the policy limit, and the total deductibles. Now, definitely we have understood the concept and the meaning of how the insurance policies are taken, what primarily the factors are taken into account before a policy is bought by a consumer. Definitely, its importance cannot be undermined. So let us now highlight the importance of insurance. Insurance is important because it provides the financial protection against the unforeseen events that can lead to significant losses or damages. Here are some of the key reasons why insurance is important, out of which the first is protection against the financial loss. Insurance policies help the individuals, business, and the organizations to protect themselves against the financial loss due to unforeseen events such as accidents, theft, natural disasters, or illness. Insurance policies provide a safety net that can really help to offset the cost of these events and prevent individuals and the businesses from suffering significant financial losses. Business and organizations, to protect themselves against the financial loss due to unforeseen events such as accidents, theft, natural disasters, or illness. The second important factor of the insurance is risk management. So, insurance is a key tool for managing the risk. By transferring the risk of loss to an individual insurance company, the individuals and the business can better manage their exposure to risk and protect themselves from the potentially devastating financial consequences of a loss. The next important point relating to importance of insurance is a peace of mind. Insurance provides a peace of mind, knowing that you are protected against the financial losses that may arise from unexpected events. This can reduce the stress as well as the anxiety, allowing the individuals and the business to focus on their daily activities without worrying about potential financial risk. Another important aspect relating to insurance is a legal compliance. Many types of insurance are mandatory under the law, such as auto insurance and workers' compensation insurance. Failing to have the required insurance coverage can really result in fines, penalties, as well as the legal consequences. So, in order to fulfill the legal compliance, certain type of policies and taking by the individuals of that policies framework is mandatory, which covers the auto sector as well as the worker compensation insurance, which is definitely a very sensitive area. If you're not complying to taking of the policies in this regard and in these particular fields, you can end up into a big devastating circumstances, that is paying of fines, penalties, and there are some legal consequences also in this regard. Another important aspect of the policies is access to resources. The insurance companies often have the resources and the expertise that can be invaluable in the event of a loss. So, this can include access to legal advice, emergency services, and the financial resources to help the individuals and the business recover from a loss. Not only these points, which are definitely showing intensely the importance of taking the insurance policy. Insurance is a cooperative method of risk sharing. It supports and also enables the international trade. It provides the financial assistance and also the support, the medical assistance, and it is a source of employment opportunities also. It offers defense against unforeseen events and the harm they may cause. So, the key benefits of an insurance contract were those described earlier, and it has also the following ancillary functions and importance in addition to what we have discussed, like the capital production. The money collected from the various premium acts as a pooled investment for the insurance industry. The insurer invests these one-time sum in money market instruments, for instance, in equities, investment funds, and other lucrative channels. Another important point which needs to be highlighted, which is showing the importance of insurance protection, is the economic development. The insurance programs which mobilize the domestic savings offer monetary stability, which leads to economic development. Also, it centers around the saving routines also. The plans for the insurance can shape the people's saving habits. They set aside a percentage of their income for the premium payments, which acts as insurance against unforeseen future issues. There are several insurance contracts which also serves as a saving or investment vehicles. As a result, the people are further motivated to spend and also the save. So now coming on to another important aspect of insurance, that is, what are the principles of insurance? Insurance is a contract between an individual or the organization and insurance company, where the insurance company agrees to compensate the individual or organization for losses or damages that may occur in the future. So, in exchange for a regular payment which is called as a premium, the principles of insurance provide the framework for how the insurance work and how the insurers assess and manage the risk. So, let me discuss now the first principle of insurance, that is, the principle of utmost good faith. The principle of utmost good faith in insurance contract requires both the insurer and the insured to act honestly and transparently towards each other. So, this principle is fundamental because the insurance companies provide security to the insured individual, but they must also protect themselves from the fraud. It is essential that both parties provide the accurate and the complete information regarding the terms and the conditions of the contract. The insurer provides the false or misleading information, they can be held responsible for any losses incurred by the insured. And on the other hand, if the insured withholds or misrepresents the information, the insurance company is not liable for any kind of damages. Coming on to the second principle of insurance, that is the principle of insurable interest. To have an insurable interest means that the insured or the policy holder must have a financial stake in the subject matter of insurance contract, such that it would cause them the financial loss if it were to be damaged, destroyed, stolen or lost. So, while determining the insurable interest, for example, in auto insurance, is usually straightforward, it can become complicated when the driver of the vehicle is not the owner. Nevertheless, having an insurable interest is a fundamental requirement for any insurance contract to exist. Coming on to the third insurance principle, that is the principle of indemnity. Indemnity in insurance refers to the insurance promise to compensate the insured for the amount of the loss up to the agreed amount in the contract. This is definitely a very crucial aspect of the insurance contract for the policy holder, as it ensures that they were to be restored to their pre-loss financial position. The third is the principle of indemnity to be continued. The compensation amount is directly proportional to the loss incurred, and the insurance company will pay up to the amount of the insured loss or the insured amount agreed upon in the contract, whichever is lower. For example, if the insured car is insured for rupees 10,000, but the incurred damages were 3,000, the insured will receive only 3,000, not the full amount of 10,000. The next is the principle of contribution. The contribution creates a corollary between all insurance policies related to or implicated in an event and an incident. This is the contribution principle. Every policy you have covering the same issue pays its share of the policyholder's loss. This provides for proportional accountability for all the insurance covered on the same subject matter and is an extension of the idea of indemnity. The next important principle is the principle of proximate cause. There are several incidents, especially those that happen one after the other, might result in the loss of insured goods. There are several sources of losses, may be the covered by property insurance, but not all of them. When a property is not protected by the insurance, the closest cause needs to be identified. The insurer is required to provide the compensation if the proximate cause is one that the property is covered by the insurance against. The insurer is not required to provide the payment if the reason is not the one that the property is covered against. The next is the principle of loss minimization. This is the last and arguable most straightforward of the principles that establish an insurance contract. It is the insured's duty to take all reasonable precautions to reduce the loss of the insured property in the case of an unknown incident. It shouldn't be the goal of the insurance contracts to receive the free things every time anything negative occurs. The next is your principle of subrogation. This idea could be little unclear, but the example will make it very clear. Subrogation is the act of taking the place of one creditor, that is, the insurance company, another insurance company representing the person responsible for the loss. So, the ownership of an item of insured property passes to the insurer once the insured, that is the policyholder, has already received the payment for the loss sustained on it. Let's imagine you are involved in an automobile accident. That was the fault of the third party, and you make a claim with your insurance provider to cover the cost of your car's damages and your medical bills. So, your insurance company will take control of your vehicle and the medical bills so that they can intervene and bring a claim against the party that caused the accident or sue them, that is the person who could have paid for your losses. So, the only way the insurance company can profit from subrogation is by recovering the money it gave to the policyholder and the expenses incurred to get it. Any additional sum paid by the third party are returned to the policyholder. Therefore, let's say your insurance company sued the irresponsible company after it had already paid you the full amount of your damages. So, they will use that to pay the court fees, and leftover amount will go to you if their action succeeds in recovering more money from the negligent third party and that they paid you. So, definitely all these insurance policies, all the principles are very important for all the students to understand. That is the principle of utmost good faith, that is a full disclosure of the information between the two parties, the insurer and the insured. The principle of insurable interest, that is the policyholder must have the financial stake in the subject matter, followed by the principle of indemnity, which refers to the insurer promise to compensate the insured for the amount of the loss to the agreed amount in the contract, and definitely the principle of contribution creates a corollary between the insurance policies related to or implicated in an event. So, this is a contribution principle, and every policy you have covering the same issue pays its share to the policyholder's loss, and definitely the insurance company will pay you to the best possible closest cost, that is the proximate cause, not for the cause for which the property is not insured. Even if you've taken the insurance policy, there is a principle of loss maximization which is very clear, arguable, that even if you have taken the policy, all the efforts to be directed in that direction so that the losses are the least. And last but not the least, the principle of subrogation. That is the subrogation is the act of taking the place of one creditor, and definitely the insurance company, another insurance company representing the persons responsible for the loss. So, all these principles have to be kept in mind, and definitely they play a pivotal role in case of the policies taken by the insured. Thank you very much.